So you wear many hats. So we
Yes.
appreciate that. You're with the Georgia Department of Community Affairs. They have been instrumental in this entire program with the rural zone and tax credit. So I have spoken to you with many questions before, so we figured we would just get everybody on a Zoom call and use this for future reference to be specific about Cairo and the development of what we have going on downtown here. So thank you so much for being here, and I will give you the floor.
Okay. All right. So can everybody see my screen? It says Rural Zone 101.
I can.
Yep.
Yes,
Okay.
can see it.
All right. So I'm pretty informal. So if you want to unmute your mic and ask a question, that's perfectly fine with me. If you don't want to do that, you want to type your question in the chat, then Ansley said she would monitor the chat for me. So with that, I will go ahead and get started and give you a little bit of background on the Rural Zone program in Georgia. Rural stands for Revitalizing Underdeveloped Rural Areas legislation. And it was House Bill 73 introduced in 2017 to the General Assembly and was signed into law by the governor in May of 2017. The purpose of the program was to provide an incentive to try to stimulate investment and job creation and economic development in rural downtowns that are struggling. And so what the incentive is three tax credits that are available on your Georgia income tax return for businesses that do business within the boundaries of the rural zone. The first set of communities were designated in January of 2018, and the designations do last for 5 years. So at this point, these 9 communities have rolled off and some new communities have rolled on. Cairo was designated in the 6th round of rural zone communities. And so the life of y'all's zone will be from January 1 of 2023 through December 31st of 2027. So it's good to go ahead and, get started, hit the ground running on this first year and get the information out about the program and have people talking about it. What we've heard from other communities is that really once a couple of businesses take advantage of this, then through their word of mouth, they're helping you to promote the program to other developers and other business owners in the downtown. We have about 43 rural zones right now around the state. This map also shows the ones from 2018. So like I said, those have now rolled off, but this sort of gives you an idea of the spread of rural zones that we do have across the state. And then this is the official rural zone map for the city of Cairo. So you do have to be located within these parcels that are sort of highlighted in that yellow tannish color. And if you have any questions about that, you can always talk to Ansley to make sure that your business is located within the zone. And then just some general tax credit information. So what is a tax credit? A tax credit is a dollar-for-dollar reduction of the amount of income tax that you're going to owe to the state of Georgia on your business's income tax return. And tax credits generally save you more in taxes than a deduction, because a deduction is only going to reduce the amount of your income that's subject to tax, whereas these credits will directly reduce your tax bill. So will directly reduce the amount that you owe. Generally, just general information about the rural zone tax credits. This is a state of Georgia income tax. It's not to be used on your federal tax return. These tax credits are unlike some other tax credits that are offered by the Department of Community Affairs in that they cannot be sold or transferred. They're also non-refundable, meaning that you use the credits up to the amount that you owe that year, and you will not receive a check back for the remainder of those credits. Instead, any money that's left over after your income tax is paid for that year is just carry forward and can be used against future years' income tax liabilities, and it can be carried forward for up to 10 years. And the tax credits aren't just for brand new businesses that open and create jobs within Cairo's rural zone, but also any expansions of existing businesses, as long as those businesses are creating at least 2 new jobs. So the program goals are to assist in revitalizing rural downtowns. Like I said earlier, those rural downtowns that are struggling and have some blight downtown, maybe have some higher vacancy, that kind of thing. By offering these tax credits for job creation and commercial investment and business activities in the rural zone to try to incentivize developers to create new businesses within the rural zone. And the 3 Georgia income tax credits are a job tax credit, an investment tax credit, and a rehab tax credit. The thing to keep in mind with the rural zone tax credits, though, is that job creation is actually the key to unlocking all 3 of the rural zone tax credits. So like I said, there's the job creation, the rehab, and the investment tax credit. But the job creation, the at least 2 new full-time equivalent jobs having to be created, is the key to unlocking all of the credits. So I'll talk about the job tax credit first. With this, at least 2 jobs need to be created, and these must be jobs that actually receive W-2s. We get a question a lot about 1099s, especially for things like downtown hair salons. A lot of time those workers are 1099s. These do have to be W-2 employees to count. And per each job that you create, it's a $2,000 tax credit per new full-time equivalent job. And this is different from our other tax credit programs where you have to create full-time jobs, meaning jobs working at least 35 hours a week. With this one, you can actually add together part-time employees' hours to equal 1 FTE or 1 full-time equivalent. So for instance, you might have 4 part-time workers, each working 10 hours a week. So total, that's going to be 40 hours. That would equal 1 FTE. So you've got 4 workers, but they equal 1 FTE. Eligible businesses that can take advantage of the job tax credit are those NAICS codes that you see listed here. Ansley has our approved list of NAICS codes, but there are those types of businesses that you would normally see in a downtown, like a law office, a brewery, bakery, restaurant, doctor's offices, banks and gift shops and retail, that kind of thing. All of those would be eligible. The job tax credit cannot exceed $40,000 per year by a single entity. So that would be, the cap is at 20 jobs. And the credit can be taken for 5 years as long as those jobs are maintained. And that doesn't mean that Susie Smith remains in the job for 5 years. It just means that that position is filled for 5 years. So let's look at an example of this, because I think that helps it make more sense. So let's say that 2 sisters have decided they're going to open a clothing boutique in downtown Cairo, and it's going to be in the rural zone. Now, first thing we're going to look at is whether or not their NAICS code is eligible. And it is. It's NAICS code 44812, which is women's clothing store. That is eligible under the program. So then we can move on. The 2 sisters are each going to work full-time at their business. And then they're going to hire 4 high school students who are going to each work 20 hours per week. So how much would their tax credit be over the 5 years? Because remember, as long as the jobs are maintained, they can take it for over 5 years. What would it be? Well, first we've got to figure out how many jobs have been created. So we've got the 2 sisters working full-time, so they're 80 hours a week. And then the 4 part-time students working 20 hours, that's 4 times 20 is another 80 hours. That's a total of 160 hours. Divided by 40 equals 4 FTEs, 4 full-time equivalents. And then what's the business's tax credit then? Well, their first year is going to be 4 jobs times $2,000 equals $8,000. And it will be the same for each year for 5 years, as long as the positions are maintained, for a total of $40,000 over 5 years for that business. Any questions on the job tax credit? I think the main thing to keep in mind with the job tax credit is that's the thing that you've got to keep in mind to even be able to unlock the investment credit and the rehab credit.
Sheree, so I think the only questions, that we've gotten to so far, we have folks that have some part-time employees. They might roll over, some of them might leave, so bringing in some new employees. So as long as those hours are maintained, that would work.
Yes.
Right. And then I know that there is a tool that we can use. So in case anyone is listening and you want to know, all right, well, I have to make sure that I have this many employees to make sure I get those tax credits. So they can utilize a worksheet
That's right.
that you guys have. So we do have that, and we can send that to you so that any employer can look, all right, if I keep these 2 jobs, I have to make sure, if they start within July, that we have to keep up those hours to redeem those tax credits.
Yeah. Yeah. And that's particularly important for an existing business. So what we have found is that with an existing business, Department of Revenue, the Georgia Department of Revenue is going to be looking very closely to make sure that you have, as a business, truly increased your employment by 2 new FTEs. So they're going to compare that to the previous year's employment. And there is a worksheet for that on a Department of Revenue form ITRZ, and I will walk us through that a little bit later in the presentation. But that is something good to look at. So just so you know, this is kind of getting down in the weeds, but just so you know, we did have a business that was turned down for the tax credits because they wound up hiring their new employees, one in July of the year and the other in December. And Department of Revenue, when they averaged that out on the worksheet that Ansley mentioned, those employees had not worked long enough, particularly the one that started in December. They only worked 1 month out of 12. So they were not considered a full-time employee for that year. So there was not an increase in employees by 2. So just keep that in mind if you're an existing business. If you're a new business and you start you open your doors in November and you hire your employees in November, it doesn't matter because you're a new business. There isn't that prior year's employment to for DOR to look back on. So those employees would be considered new, even though they were hired in November. Hope that's not clear as mud, but just keep that in mind if you're an existing business. Always do that worksheet that Ansley mentioned. Now, the investment tax credit, that is going to be equal to 25% of the purchase price of a building, not to exceed $125,000. The investment credit cannot exceed $125,000, not the purchase price of the building. And the building needs to have been purchased after Cairo became a rural zone, which was January 1st of 2023. So just keep that in mind, that date. And then 25% of the purchase price of the building could be used as your credit. This bullet just says an eligible business needs to be located in the investment property and create and maintain a minimum of 2 full-time equivalent jobs. So that's what I was mentioning earlier. You still have to create the 2 jobs in order to get and qualify for the investment tax credit. Now, let's say a developer comes in and purchases the building and maybe renovates the building. He can either put his own business in there and have the 2 jobs be his employees, or the developer could lease that space out to multiple businesses, and then those businesses create the employees. In the first instance, the developer would take the job tax credit and the investment credit. In the second instance, the developer would take the investment tax credit, but those businesses that he's leasing out to that create the jobs would take the job tax credit. With the investment credit on the tax return, the credit is prorated equally over 5 installments. And the example of this is, let's say a local developer purchases a 2-story, 5,000 square foot building in Cairo's rural zone for $400,000. His plans are to renovate the entire building into 4 apartments on the first and the second floors. So what is the amount of his investment tax credit? This is actually a trick question because if he is just converting this into 4 apartments, then there would be no job creation. Therefore, he would not be eligible for the investment tax credit. But let's say that his plans instead are he's still going to renovate the upper floor into 2 apartments, but the first floor he's going to lease out to a new law office who is going to create 2 full-time employees. And a law office is an eligible NAICS code under this program. So what would be the total amount of his investment tax credit? Well, the building purchase price was $400,000, so 25% of that is $100,000. And then, as I said, this one has to be prorated over 5 years. And so as long as 2 jobs are maintained over that 5-year period, the investor would be able to get a $20,000 Georgia tax credit per year for 5 years. A frequently asked question on this one is, can an investor who comes in and purchases vacant land in Cairo's rural zone, would they be eligible to receive the investment tax credit? And the answer to that is yes, they could. But if they do decide to move forward and say construct a new building on that vacant land, they would not be able to take the rehabilitation tax credit for the cost of constructing that new building, because it wouldn't be rehabilitation of an existing building, it would be new construction. So no, that would not be allowed. Are there any other questions on the investment tax credit?
So I'm noticing in the chat, we do have a question, not on this tax credit, but Summer Days has asked how do you find out if we're in the area? You're on First Avenue Northeast. So Summer, I'll connect with you and let you know, depending on which building. But First Avenue Northeast is included up until around 4th Street. So we can chat further on that. And then she asked, how do we enroll in this program? There's an application process, and we'll go through that later.
Mm-hmm. Yes, I'll talk about that in a few minutes.
A good question, Summer. Thanks.
Yes. All right, so next is the rehabilitation tax credit, and that's going to be equal to 30% of the qualified rehab cost. Again, this tax credit cannot exceed $150,000, so it's capped at $150,000. And for this program, qualified rehab costs are labor and material costs. This credit is prorated equally over 3 tax years, and the taxpayer cannot use the same qualified rehab cost to generate any other state income tax credits. And more often than not, that would be looking at the Historic Preservation Division state income tax credit for rehabilitated historic properties. So you would have to look at this program and calculate your potential tax credits versus the Historic Preservation Division's Historic Preservation Tax Credit, figure out which one is more beneficial to you, and then go with that one. But you basically can't double dip on this program. The thing to keep in mind is we do have a set of rehab standards. I'll go through those 10 in just a second. Ansley, do y'all have a Historic Preservation Commission that reviews exterior changes to properties in your downtown? I should have asked you that earlier, sorry.
Yeah, so we don't technically, our Downtown Development Authority reviews all of that currently. Debbie, do you have any more information on that? If you guys have, because there were some guidelines at one point, I believe, but currently no.
Okay, so you don't have an HPC.
No.
Okay, so in communities where there is a Historic Preservation Commission in place that reviews exterior changes to their local historic district, we would accept a certificate of appropriateness from that HPC. But since y'all don't, you definitely need to make sure that any work that you're doing on buildings in the rural zone, any exterior work, we don't look at interior work, needs to follow these standards. And I'll go through the standards. There are 10, and we could write a lot more about these rehab standards to get into, excruciating detail on everything that you might do. But I think the best thing to do is, if you're considering making a good many changes to the exterior of the building, go ahead and write out what you're thinking about doing, and then you and I can talk about that, or me and you and Ainsley can talk about that. and run it through our reviewers to make sure that it looks like any of the exterior work that you're going to do is not going to go against these standards. Basically, what we're talking about is if it's an historic building, and historic is at least 50 years old, and it's terrifying to me that because I'll be 50 years old this year. So any building built before 1973 at this point is considered historic. So we would be looking at those buildings built before 1973, making sure that any historic details on that building you would not remove during the rehab. If the building historically had windows on the upper floor, we don't want to see you board those up or brick those in or that kind of thing. So we want the historic character of the property to be retained and preserved where at all applicable. If you do have to remove historic materials because they're rotted or deteriorated, we would want you to replace those with ones that are in keeping with the rest of the building. We don't want you to add things that add a false sense of historical development. I know in Georgia, people do like to add fancy columns to buildings and that kind of thing, but we don't want to do that if that's going to create a false sense of history on the building. Changes that have occurred and acquired historic significance, meaning that they're at least 50 years old, should be retained and preserved, and distinctive features and finishes and construction techniques should be preserved. Already talked about that one. Chemical and physical treatments, especially sandblasting. Sandblasting brick is not a good practice. So want you to try to use the gentlest means possible, something that's not going to destroy that finish on the brick that makes it impenetrable to water. Number 8 is a general one for the state. We don't usually get into archaeological type resources in downtown. Any new additions or exterior alterations, particularly if a story is going to be added to a building or an addition is going to be added to the building, we would definitely want to talk with you about that, because that could majorly change the appearance of a historic resource. And the same with that one. So those are our 10 rehab standards. Like I said, if you have any questions, we can definitely talk through what your plans are to make sure that they're going to adhere to the guidelines and you won't do anything to risk not being able to get your rehabilitation tax credits. An example of the rehab tax credit would be same one we talked about before, the same example where the developer is going to renovate the second floor into 2 apartments and the first floor into the law office. And he's going to spend a total of $300,000 on the first and the second floor with the rehab work. And so 30% of that is going to be $90,000. And remember, I mentioned this has to be prorated over 3 tax years. So as long as the 2 jobs are maintained over the 3 tax years, the developer would be able to get $30,000 per year as a tax credit. And remember, he may not be able to use all of that tax credit in 1 year, but he could carry forward that tax credit up to 10 years from the year that the tax credit is gained. Question I often get is, can all 3 of the rules on tax credits be combined? And the answer is yes. Here's an example of that down in Bainbridge. This is the Southern Philosophy Brewing Company in downtown. It sits on the Courthouse Square down in Bainbridge. And this is some interior work before rehab. They ran into a lot more rotting than they really originally thought they would when they started the rehab work. And now here's what it looks like after on the exterior and interior. And it's now a very successful tasting room, bar, brewing facility in downtown. And they were able to take advantage of all 3 of the tax credits. So they created 3 jobs. So that's 3 times $2,000 is $6,000 per year. They spent around $41,000 on the building, so 25% of that is $10,250. And then they spent around $70,000 on the rehab of the building, exterior and interior. And so 30% of that is $20,910. So the first year they were able to gain tax credits equal to $15,020. And then over 5 years, the total tax credits that they've been able to earn is 61,160. So you can definitely layer those tax credits. Any questions on the rehab tax credits before I move on to more of the paperwork?
Sheree, there was a question that others might have that will tune into this after the fact, but one of those questions was, all right, if I'm the investor, I'm coming in, I'm looking at this building and someone else is rehabilitating it. So as long as it's within that parcel, those tax credits can be broken up into that same building.
It's a building and only part of it's going to be rehabbed.
So say, well, the whole building's going to be rehabbed, but you have an investor, they purchased it. And so then you have someone, they're coming in, they're going to rehab it. And then you have another business owner, they're going to rent it out to, that's going to create the jobs. So it's broken down
That's right.
into those businesses.
That's right. That's right. So yeah, so if say it's a developer that buys the building and he rehabs the building so that he can then rent it out to multiple businesses, then yes, the developer could take the investment credit and the rehab credit, and then the businesses that he leases out the space to, those are the ones that actually create the jobs. Those businesses are the one that takes the job tax credit. But just keep in mind that the jobs have to be created in order for that and the developer to be able to take the investment credit and the rehab credit.
Right. And I guess we can go over that more on the application part so that we know what their steps are to make sure that they're fulfilling their end.
Okay. Okay. All right. So it's pretty simple. If you're thinking that, you've created the 2 new jobs and you want to take advantage of it, or you've done the investment and the rehab and you've got the jobs created, then it's this 1-page certification form that has to be filled out first. And the part 1 of this is something that the business is going to fill out. So it's pretty simple: name of the applicant, the address, parcel number, NAICS code, name of business creating the jobs, number of FTE jobs created in the taxable year, and then a signature. Then the business is going to send this to Ansley, and Ansley is going to be the person that's going to fill out part 2. So she's going to sign off and say that the location, yes, is definitely located within our designated rural zone boundaries. And they've followed all of our zoning regulations and that kind of thing. So I'm signing off on it. After part 2 is done by Ansley, then it's going to be sent to my office, part 3, to Trisha DePadro in our office, and she will complete part 3 so that the certification is signed fully. And then once the business wants to submit their income tax returns, this form and the letter that Trish is going to send back have to be attached to the business's income tax return, along with the Georgia DOR form ITRZ. And I'll go through that in a second too. So all those things need to be submitted with the income tax return. And I basically just said that. So the ITRZ, this is a Department of Revenue form, and it does have to be completed. And it's a fairly simple 5-page form where if you're wanting to take advantage of the investment tax credit, here's where you put in the purchase price times 25% and you get the amount. And then you're going to do the rehab expenditures. Again, you're going to put those in here and take 30% of that. Department of Revenue does not require that you attach things like a settlement statement to show and prove that to prove the purchase price of the building, nor do they ask for contractors invoices and that kind of thing to support how much you've spent on the rehab. They don't ask for that to be included, but I would say you definitely need to keep that kind of information in a file somewhere in case you're ever audited, because you will need to produce that information then, but you do not have to attach it to this ITRZ. Page 3 is the important page. This is the one where, particularly if you are an existing business, you're going to be comparing this year's number of full-time equivalents to the prior year's number of equivalents, and you do that by month. So just want to make sure that if you have any questions, if you're an existing business and you're questioning whether or not you you have increased employment by 2, you can always do this worksheet, page 3. And if you have any questions, you can always call me. And that's just, again, it's showing number of jobs again. And then the summary is as whether or not you're taking all 3 of the tax credits or just 1 of the tax credits or 2 of the tax credits. And that's it. So a reminder, sorry, my dog is in here. The credit can only be used against Georgia income tax liability. The amount of the tax credits for a taxable year cannot exceed a certified entity or certified investor's total state income tax liability. And you won't get a check back for the remainder, but any unused income tax credit can be carried forward for up to 10 years to use against what you might owe the state of Georgia in future years. And then I just have, again, a list of frequently asked questions to go over. Are these tax credits transferable or saleable? No, they're not. Other tax credits are, but these are not. And how can these credits be used? They can only be used against your Georgia income tax liability. They cannot be used against payroll withholding. Again, some of our job tax credits can be used against payroll withholding, but not this one. And if the investor or business cannot use all of its tax credits, can the business receive a tax refund? I answered this at the beginning. You won't get a check back, but you can carry forward your tax credit for up to 10 years. What happens if the business's number of employees falls below the required 2 FTE jobs? What would happen is that you would not get the income tax credit for that year. However, if in the next year you do increase the employment back to the 2 FTEs, you would be able to resume getting your tax credit, and you would not have to pay back any income tax credit that you got from previous years. Let's say there are 2 businesses located within a property, and one of the businesses employs 1 FTE and the other business employs 1 FTE. Can the investor that purchased the building take the investment and or rehab tax credit? The answer to that is yes. The investor would be able to take the investment credit and the rehab tax credit, because within that building, within that single address, 2 new FTEs have been created. But the 2 businesses that each created 1 job each, they would not be able to take the job tax credit because each one only hired 1 job instead of 2. And you have to have the 2 FTEs to qualify as a business. What types of expenditures qualify for the rehab tax credit? Only those costs associated with labor and materials. Can a person who purchased and rehabbed a building but does not receive a W-2 qualify as a new job? No. The person, the investor or owner cannot count themselves as an employee if they do not receive a W-2. If the owner sells the property, would they be penalized for previous tax credits that they used? Would they owe anything back? The answer is no. If in the 3rd year of the 5-year period, the developer decides to sell the building, they will not have to pay back any of the tax credits they got previously. But moving forward, their rules on tax credits would end once the ownership changes. Are there any other questions that have come to mind as I've been talking?
Everyone feel free to answer if you're thinking it someone else might be. And I don't see any other questions in the chat. I think you've answered all of my questions throughout the presentation, but open
Yeah, I
to?
think the main thing is to make sure that, number one, you've created the jobs, and number two, that you have an NAICS code that qualifies under this program. Now, I will say, if by some chance, and Ansley knows this, if by some chance you do not have an NAICS code that qualifies under the program, we do have a way for you to request that your business be included. And we can do a one-time approval of that, so that you can get into the program, especially if the city supports your business being in downtown. So that is an option. Just keep that in mind.
Jennifer Jarvis, our chamber director, said great information. Definitely.
Good.
I
Good, good,
think-
good.
I think that's it. Does anyone else have any questions? I'm not seeing anything, but Cherie, thank you so much for taking the time to do this with us today. I know that a lot of people will be very thankful for this information. So we are about to put your presentation video everywhere. So if you see your face on YouTube,
Yes.
you're welcome. So
Yeah.
we'll be putting this on our website for any of anyone in the group or anyone watching the video in the future. This I'm gonna put my information on the video so that you have any questions moving into the future, you can contact us at any time. Cherie, thank you for putting your information here on the presentation. We can help answer any questions that are specific to our rule zone and area. So if you have any questions, we're here to answer, and we're excited to, we want to be the community that sends the most applications.
Yes. Yes.
That's our goal. But thank you to everyone that has participated today and that are watching this in the future. Cherie, thank you again. And the Department of Community Affairs. This is a great program. We're excited to see what it does for Cairo.
It's exciting to see what the individual communities do with this. So yeah, it's exciting to see the changes and the decrease in vacancy and the decrease in blight that we're seeing in our rural zone downtowns. It's really exciting. My contact information is on here if you need me. Also, Tricia DePadro's contact information is on here. She is DCA's, our Office of State Economic Development's CPA. And so if you're getting way down in the weeds with your CPA on trying to take this tax credit, I would advise you to connect your CPA to Tricia DePadro, and they can speak the same language and get any questions answered.
It's great advice. Thank you so much. And Debbie, our Downtown Development Board Chair, she said, thanks, Cherie. Now we just need to spread the word.
That's right.
That's
right.
right.
Promotion is key.
Yes. But thank you again. And Shelley is saying thank you too. And we're so happy to have you. And we're going to have it. Our goal is to send you the most applications.
Sounds great. All right.
Thank you and have a great one. And
Y'all too.
Everyone take care.